Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News9 where we break down the day's action on the Lal Street. And it was a very interesting session for the Indian markets today. I mean, on the surface of it, not much has changed since yesterday. Nifty pretty much ended on a flattish note. Bank Nifty too ended little unchanged as well. But you know, a lot of volatility has seeped in to the markets. You know, Nifty today traded in this broad range of about 200 points. Bank Nifty on the other hand traded in a massive 900 point range, and both indices have formed spinning top and doji sort of formations on the price chart, which indicates that there is clearly a lack of direction as far as these two indices are concerned. I mean, in simple terms, it's a fair game for both bulls and bears out there as far as Nifty and Bank Nifty go. And I mean, while there is still a lack of clarity for both indices, the ball clearly seems to be in the court of the bears as far as the broader markets are concerned. Both mid and small cap indices fell 1.5 to 2% today. The mid cap index is now down about 3.5% from its peak. In terms of level, it's at its lowest point since February 14, so pretty much a 1 month low. But you know, considering the kind of returns we have seen from mid-cap stocks over the last 12-15 months, I mean, a 3.5% dip should not be that concerning. Plus, remember that it's a relatively smaller universe. There are just 150 mid-cap stocks, and DIIs have been big buyers in these stocks in the last 12-15 months. And we know that they don't trade stocks as actively as retail investors do. So that perhaps should insulate mid-caps from a much deeper and painful sort of a correction from here on. However, the same cannot be said for the small caps. Now, over 95% of Indian companies are considered small cap. So, I mean, the universe is huge. Plus, data shows that the rally in the small cap space particularly was primarily driven by retail participation. Some of it came from DIIs, but if you look at the historical averages, FIIs have actually reduced their positions in small cap. Now, all of that, at least in my mind, makes this rally that we have seen in the small cap space a little bit suspect. But again, this is all in retrospect. Not many of us were questioning this rally when the prices were going up, but now that they have started falling, and falling how, we are all turning cautious. I mean, the small cap index on the whole is down about 10% from its peak. It has, by the way, also turned negative for the year 2024. It's down by about 0.5% or so for the year. And many of these constituent stocks, they have corrected in excess of 20% in just 2 weeks. So clearly there are signs of caution in the system. There are concerns about the valuations of the small caps and the mid caps, small caps particularly. Also, remember on Friday, mutual funds have to submit their the MF stress test report, which was mandated by AMFI, and that would give us some clarity as to how quickly can these funds liquidate their position and what sort of a cut and price impact that they would face once theoretically they have to redeem their portfolios. But to understand where we go from here on, because again it seems like it's open court for both bulls and bears, let's also welcome Mr. Kranti Bhatini of Wealthmill Securities. Thank you for joining us here on News9, Kranti. I want to start with talking about Bank Nifty. I mean, it traded in this huge 900 point range, and I think the technical expert enthusiasts will appreciate it, that it formed a spinning top sort of a candle on the price charts. But we are also seeing this huge divergence in performance in HDFC Bank and other banking stocks, primarily the PSU ones. I mean, the PSU bank stocks corrected by I think 2 to 6% today, whereas HDFC Bank was responsible for nearly half of Nifty's gains. I mean, in my mind at least, it sets us up for a very interesting expiry day tomorrow. What's your sense of things here? Are we in for a big move from here on?
Yes, Suyash. Good afternoon to you. Suyash, we are witnessing a very interesting things in the market at this point of time, where there was a lot of optimism and euphoria on mid-cap and small-cap space. It has been quite a number of days. There was a lot of heightened activity. Now, mid and small cap stocks have been taking the sideways, coming to the people ignored the large cap universe in the recent past, and that too, people who are chasing the PSU banks. Now the rotation is coming, the attention is coming towards the high quality stocks like HDFC Bank. This shows the classic case with respect to the bull market at this point of time. What it demonstrates in the market is there is an ample liquidity in the market right now that has been getting into the channels where the ample value is reflecting at this point of time. Markets are maintaining that positive breadth overall. We are in a positive territory at this point of time. Overall, markets are concerned. Nothing to worry. But what we can sense is due to the commentary from the regulator and also the current setup that we are witnessing, some kind of fear has been creeping into the mid and small cap space. You rightly mentioned about how this universe works. So as long as we are maintaining the current level, we are in a positive territory. But going ahead, what we can witness is don't expect a broad-based rallies in these mid and small cap space. Right now, men will be differentiated from boys. That's what it's going to happen in mid and small cap universities concerned. Companies which have a strong earning outlook, strong cash flows, these are the parameters that drives the stock prices going ahead, because stock prices always slaves to the earnings. So if there is any kind of dichotomy, if there is any kind of gap between the earnings and the valuations of the company, that's where the froth comes into the picture, and that's where the stocks are getting into corrective movement. If investors are holding, there is nothing to fear about holding a mid and small cap stocks in their portfolio. But if the companies don't match the figure of valuation and the earning outlook, that's where the crux is. That's where investors need to take a strong decision.
All right, and speaking of excess liquidity in the system, I mean, do you think that the regulatory actions we have seen over the past few months with RBI, with NBFC, SEBI, with mid-cap and the small-cap focused fund, could they be perhaps directed towards, bringing down leverage in the system ahead of elections specifically? Because I ask this because, I was reading this report which suggested that certain option traders and HNIs who previously were able to secure financing at rates as low at 8 to 9% are suddenly finding that their lenders have become, more tight-fisted. I mean, and if you think about it, there is clearly an overlap in this correction that we are seeing in the PSUs and the broader markets with regulatory tightening. I mean, what's your sense of things over here, Kranti?
So, we need to differentiate two things. One is how the regulator have handled this rally. One thing is the regulator are proactive. They have been proactive. They imposed many speed breakers with respect to controlling the speed of the market, with respect to, they brought a lot of measures controlling the space of the stock prices, to control the pace of the stock prices. First and foremost, they brought like ASM, additional surveillance measures, graded surveillance measures. They brought even ESM measures for the small companies which have a small market cap. So in a regulatory way, they have well maintained, and they kept the barricades and they kept the speed breakers to control the pace and speed of the some kind of stock that have been going up in the market in the recent past. Coming to the leverage is concerned, they brought a lot of changes, and they taken the calls with respect to the controlling the NBFC lending is concerned. So the regulators are proactive, and they are taking some kind of additional measures to control any kind of froth in the markets, and to should not give any kind of chance to the bubble. That's where the regulators have been acting.
Fair enough. But I mean, in light of recent development, it looks like Friday particularly is going to be quite an explosive, session for our markets. We have the electoral bond details that will be made public by the Election Commission on Friday. Also, the results of this mandatory stress test for mid-cap and the small-cap focused funds will be out. I mean, both events, at least in my mind, Kranti, they seem to, have some massive implications in the offing for the markets. What's your view, sir?
Yes, there are a couple of big events are lined up, and as the markets are in a giving the knee-jerk reaction to these events already, so we need to wait and watch, but nothing to panic. Okay, end of the day, the company earnings or company fundamentals are not going to change because of these events. The one thing is, it's going to create some kind of knee-jerk reactions, But if the companies have a strong fundamentals, investors need not have to frighten about these events. These events do come and go in the market. But one thing is clear: company earnings are not going to change because of these events. That's what the thing one need to keep on their mind always when they're starting the investment journey or designing the investment strategy for their portfolio.
All right, sir. But we also have retail inflation data both in India and US that will come out later today. I mean, do you think if there is any big surprise, especially on the negative side and for the US particularly, could that be a tipping point for equities in the near term? Because, the markets clearly they are looking exhausted both over here and in the US. Over there, the problem, has started, the correction has started seeping in the tech stocks. Over here, we are clearly seeing a crack in the broader markets as well as PSU names. So, what do you think? Do you think that this retail inflation, data that holds the key?
Suyash, probably we can expect some softening of inflations both in domestic and overseas in US. But I don't think so right now. The kind of commentary and the body language what we are getting from the Federal Reserve and in the domestic economy, I don't think so. They are in a mood to jump and reduce the interest rates immediately. So we need to wait and watch some more time. Our patience going to get tested before getting a first rate cut. So I'm not in a camp where expecting an immediate rate cut, but welcoming the rate cut. But I'm not in a camp where there is an immediate rate cut. Of course, rate cut is going to be imminent, but the timing might take time before getting the indication. Suyash.
I mean, Kranti, you expect, softer inflation data both here and in the US. And I mean, that overall works out well for the Fed particularly, right? Because Mr. Powell, he has been hinting that, maybe the time has come for monetary easing. Also, we have elections in the US, by the way, later this year. I mean, I'm not trying to draw parallels between the two, but clearly there is something, right?
Yeah, absolutely. What you said is absolutely correct. But they should not be in a position looking at just one month data or one quarter data and getting it a conclusion. So what they want to do is should be a sustainable reduction of the softening of the prices and the inflation. That's what Federal Reserve or the domestic economy also looking forward at this point of time. So that's where the overhang right now. Otherwise, the rate cut would have been came into effect in the immediate basis. But what the Federal Reserve or the domestic economy has been, they are waiting for some kind of confirmation, for a strong confirmation for the softening of the prices, and also the price has to be at a sustainable pace at a lower range. That's what the Federal Reserve is looking forward at this point of time, Suyash.
All right. And I mean, considering, there are a lot of events, binary events as well, in the lead up to the elections, and considering the kind of volatility that we have seen in the last couple of weeks, Kranti, what should be the strategy for the risk averse investors? Should they just, probably sit out, wait for the dust to settle, get some clarity as far as, the election results are concerned, and maybe then re-enter markets?
Flash, one thing is, if an investor is a risk-averse investor, one thing is they need to stay away from all the noise what we are getting on a day in and day out basis. Right. And as the investors believe in the India's long-term story, one need to use these kind of knee-jerk reactions and tips and the volatile movements to take these movements as an opportunity to build their portfolio. That's what the investors need to have a strategy at this point of time. One is the factor of fear and greed. Greed is playing right now in the market. So one need to have a strategy to utilize every dip in the market to build the portfolio for a longer term basis. And traders and the risk takers and can do with the stop losses. They have the strategy. But the majority of the investors are the risk-averse investors. That's where the crux is. They can probably use every dip and invest in India's growth story in a very staggered manner. That's what the strategy to be in the coming next few weeks or few months.
All right. I mean, that strategy would clearly work out in the lockdown, but I mean, that's not really how the minds of retail investors work, no, because they pretty much are seeing the prices go up and down like so sharply on a daily basis. I mean, how do they really, give themselves a peace of mind and really, build that, how do you say, this correction proof sort of a portfolio?
So yes, one thing is, if the day we start investing in the market, we should know who am I. Okay, whether I am an investor or a delivery-based trader or I am a jobber. So one should be clear what I am doing in these markets, what kind of position when I am taking any position. Whether it is an investment position, it is all about the earnings of the company and the cash flows of the company, how it's going to determine the future outlook of the company. So there will be day in and day out, the noise will be there always. The sentiment might be one day positive, the sentiment might be negative on the other day. So it drives the prices on a every minute basis because of this continuous momentum in the market. But the sustainability of the prices always comes with the long-term nature of the market, that equities always slaves to the earnings. So when the earning outlook of the company is quite strong, investors need not have to worry about, and the remaining, the traders and the jobbers, we know they have to position their position as per the movements in the markets. That's what happens in for the markets are concerned. So if the investor decided that he is a long-term investor, nothing to worry about what's going to happen every minute in the market. Otherwise, if they are habituating these kind of nature and habits day in and day out, just refreshing the price for every minute. Since we are in the smart world, everybody have the smartphone, and the prices they can refresh every minute. Okay, that's not the investment strategy.
Fair enough, sir. And before we let you go, there is one other thing that I wanted to talk to you about, because while we all are tiptoeing around, the signs of caution that is starting to show in equities both domestically and globally, those Bitcoin enthusiasts out there, they are probably like, what caution? I mean, it's on this unstoppable rally train. It has hit 72,000. Now it's up almost 60% in just 2024 alone. I mean, regulatory and taxation hurdles aside, do you see Bitcoin as a legit investment option, or is it just too wild for your taste?
So yeah, with respect to Bitcoin is concerned, I don't perceive still Bitcoin is an investment avenue. It's one of the highly speculative instruments. Sometimes highly speculative instruments tend to yield the highest amount of return. It doesn't mean that it has become a safe haven. It do comes up with a lot of volatility, and those who can embrace the highest paramount volatility in their portfolio, who are the highest risk takers, they can consider. Otherwise, there will be always different kind of avenues that do come into the market space, and they tend to give a highest amount of return. But these are all suitable for the high risk traders or high risk appetite speculators, not for the investors who comes up with a understand the prospects of some avenue and which drives the markets over a period of time. That's where the investors have to get in. Remaining, one should not chase every instrument that gives the highest amount of return.
All right, don't chase every investment that gives the highest amount of investments. I mean, learn from what happened and what's happening actually in the broader markets. They were running up, now they are correcting. And I mean, more importantly, I think the message I'm getting from you here, sir, is that analyze your risk appetite. I mean, if you can't take that risk, don't go seeking out these high yielding investments in the first place. Again, sir, thank you for joining us here on News9. Always great insights from you.
Thank you, Suyash. Always my pleasure to share my views with you and with all the viewers of News9.
All right, with that, it's a wrap on this edition of Last Week. Thank you for watching.
start with the end in mind. You need to know where you want to reach. Every morning that we wake up, we are exercising our choice. The destiny is decided. The results are known that I'm going to win.